All right, here's an audit sim on subsequent events. Subsequent events occur between the date of the financial statements and the date of the auditor's report. How important is this topic, subsequent events? Well, you might not believe this, but I get more instant messages on Facebook from CPA candidates regarding subsequent events than any other audit topic. So I said we got to put together something like a sim here. So subsequent events occur between the date of the financial statements and the date of the auditor's report. The auditor should perform procedures to determine whether subsequent events are appropriately reflected in the statements. Now, what does appropriately reflected in the statements mean when it comes to subsequent events? Well, the accounting treatment of subsequent events depends on whether they provide evidence of conditions that, one, existed at the date of the financial statements, which would require adjustment to the financial statements at year end, or did not exist at the date of the financial statements. A sudden event happened in the subsequent period, which may require footnote disclosure if this amount is material so that the financial statements are not misleading. So subsequent event, it might result in restatement, adjustment of financial statements at year end, or it might simply result in a footnote disclosure, or it might not result in anything. Now, for each numbered item, we're going to answer yes or no whether the audit procedure described provides evidence regarding subsequent events. So here we go. Number one, compare the latest subsequent interim financial information with the financial statements being reported on. So would that procedure provide evidence of subsequent events? Events that either require restatement or footnote disclosure? And the answer to number one is yes. Subsequent events procedure involves reading the latest subsequent interim financial statements. These interim statements, they might have come out in January or February, and they might provide evidence about conditions arising subsequent to the balance sheet date that need to be disclosed to prevent the statements from being misleading if these statements have not yet been released. Because maybe a major catastrophe happened, like a loss of the company's only manufacturing plant due to an earthquake in the subsequent period. Well, subsequent events that provide evidence of conditions that arose subsequent to the date of the financial statements, they're going to require footnote disclosure. Why? To prevent the statements from being misleading. So nothing needs to be restated, but we need a footnote disclosure if indeed the latest subsequent interim financial information disclosed a huge loss, a major catastrophe, like the loss of the company's only manufacturing plant. Number two, comparing the financial statements being reported on with those of the prior period. So in number one, we compared the financial statements being reported on with the latest subsequent interim financial information, and we said, yes, that's a procedure that would provide evidence regarding subsequent events. What about number two, comparing the financial statements being reported on with those of the prior period? No, that would not be an audit procedure that would provide evidence regarding subsequent events. It's an audit procedure that would be performed, but not to provide evidence regarding subsequent events. When would you compare financial statements being reported on with those of the prior period? That's an analytical procedure. That's performed at the beginning of the audit in the planning stage. That's an analytical procedure, but that procedure will not provide evidence regarding subsequent events. Number three, communicate material weaknesses in internal control to the client's audit committee. Is that an audit procedure that provides evidence regarding subsequent events? No. The auditor's communication of material weaknesses to the audit committee, that's not going to disclose the occurrence of subsequent events. That would not result in any restatement of financials or even footnote disclosure of something that, a transaction that did not exist at the date of the financials but happened suddenly. No, but communicating material weaknesses in internal control to the audit committee, it's an audit procedure, but it is not going to provide evidence regarding subsequent events. Number four, investigate changes in non-current debt occurring after year end. Yes, procedures that should be performed to provide evidence of subsequent events as near as possible to the report date. include investigating any changes in non-current debt after year-end. This type of event does not require adjustment of amounts in the financial statements, but the auditor should evaluate these changes in non-current debt to determine whether disclosure is necessary for proper understanding of the financial statements. So if they suddenly borrowed a lot of cash after year-end, you would want to have a footnote disclosure of that. Number 5, reading the minutes of meetings of those charged with governance after year-end. So if there are meetings of those charged with governance after year-end, should we be reading the minutes of those meetings in January? Would they provide evidence regarding subsequent events? Absolutely yes. Subsequent event procedures include reading the minutes of meetings held after year-end of those charged with governance, of management, officers' meetings, anything that took place in January. You would want to read the minutes of those meetings because they could easily uncover evidence of subsequent events, and that might impact conditions that existed at the date of the financial statements, which would require adjustment, or it might just disclose some information that did not exist at the date of the financial statements, happened suddenly, and that might require disclosure, footnote disclosure, if this amount is material. Number 6, determine whether the company's stock price declined significantly after year-end as a result of a major financial advisor's negative outlook on the company's long-term prospects. So if Jim Cramer talked the stock down in the subsequent period and as a result the stock price fell, would that be considered some type of subsequent event? The answer is no, because the market price of a company's common stock is not a financial event that affects the fairness of the financial statements. So no revision or footnote disclosure of the market decline is needed, even if it did occur as a result of an advisor's call. Number 7 now, investigate personnel changes in the accounting department occurring after year-end. And the answer is no. Personnel changes after year-end do not typically relate to the recording of subsequent events. No changes in personnel after year-end are going to result in the financial statements having to be restated or some footnote disclosure. Certainly not personnel changes in the accounting department. Number 8, inquire of management whether any unusual accounting adjustments were made or considered. That for sure is a subsequent event procedure. Inquiring of management as to whether any unusual accounting adjustments were made or even considered, because that could lead to adjustment of the financial statements. If any unusual accounting adjustments were made at year-end, you might have to find out about it and then ask the client to reverse out the effects of it. Number 9, inquire about payroll checks that were written before year-end but cashed after year-end. No, the checks were written in the year under audit, so the assumption is the checks are properly included already as expenses on the income statement. Determining which year those December payroll checks were cashed is of no significance, as it would not lead to any restatement of financials, nor would it identify a subsequent event that needs a footnote disclosure in order to keep the financial statements from being misleading. So whether those checks were cashed in the year under audit or in the subsequent year, we wouldn't have to inquire about that as far as subsequent events go. The only time we'd be interested in what year those checks were cashed would be if we were doing a bank reconciliation and then those checks might be outstanding at year-end. Number 10, examine changes in the quoted market prices of investments purchased since year-end. And that would be a no, because investments purchased after year-end do not affect the current year's balance sheet. Now, what if this question would have asked about investments that were already on the balance sheet at year-end, and then you look in the subsequent period? Would you look for the valuation? No, because we don't mark to market in the subsequent period. We mark to market our investments at year-end. But this question asked about changes in quoted market prices of investments purchased since year-end. So what we bought in January, that's not a subsequent event. We don't care about that as far as December's balance sheet goes. Number 11, inquire about the current status of transactions that were recorded on the basis of preliminary data. Yes, the auditor should inquire about the current status of any transactions that were recorded on the basis of preliminary data back in December, because the inquiry may discover subsequent events that require adjustment of or further disclosure about the preliminary data. Example, an estimated loss that was booked at year-end based on preliminary data. If more information becomes available in the subsequent period, this is an example of a subsequent event that provides evidence of a condition existing at year-end and thus should result in restatement. That's a type 1 subsequent event. So if that loss was booked at year-end based on a contingency and you estimated it using preliminary data, and then in the subsequent period that contingency loss settled for more or even less than what you booked it for at year-end, that's a subsequent event. That would provide evidence of a condition that existed at year-end, and now you have to restate the financials. That we said is a type 1 subsequent event. So you would always inquire about the current status of any transactions that were recorded on the basis of preliminary data. Number 12, obtaining a letter of representation from management regarding whether any assets in the subsequent period have been appropriated by the government or destroyed by natural disaster. Do you think obtaining a letter of representation from management, the management rep letter, has something to do with disclosing subsequent events? Of course. Subsequent events are one of many written representations obtained from the entity. The auditor should obtain written representations dated as of the date of the auditor's report from management stating that adjustments or disclosures have been made for any subsequent events requiring such treatment, including asset appropriations by governments or assets destroyed by natural disasters. So the auditor asks if any of these things happened, and then the auditor should determine whether any subsequent events have been properly accounted for and disclosed. Appropriation by the government could mean the government, let's say a foreign government, seizing assets that belongs to the entity. If that happens in the subsequent period, you would want a footnote disclosure of that. Same for a natural disaster. Because it did not exist at the date of the financial statements, it's sudden. So that might require footnote disclosure in the financial statements if the amount is material. Number 13, determine that changes in employee pay rates after year-end were properly authorized. Would that be an audit procedure providing evidence regarding subsequent events? No, it would not. Changes in employee pay rates are not typically considered material subsequent events. Even if the rate changes in January were not authorized, this would not impact December figures. It wouldn't be a type 1 event, nor would it need to be a footnote disclosure as a subsequent event to keep the financial statements from being misleading. Number 14, recompute depreciation charges for plant assets sold for substantial gains since the year end. Would that be an audit procedure providing evidence regarding subsequent events? No, it would not. Depreciation expense for the audit period does not change as a result of selling assets in the subsequent period. Therefore, whether assets were sold in the subsequent period or they weren't sold, that won't change depreciation expense for the period under audit. The sale of the plant assets will be reflected in the subsequent year's financial statements. So this would not result in a type 1 adjustment nor a type 2 footnote disclosure. Number 15, inquiring as to whether any credit losses have been reported in a subsequent period from any acknowledged distressed customers' bankruptcy filings. So here, we want to know whether any credit losses have been reported in January from any customers that we already knew about that were in financial distress. So that means it existed at the date of the financial statements already. Now we want to know more information. So that certainly would be an inquiry that we would make to provide evidence regarding subsequent events, particularly a type 1, because if there were any credit losses in the subsequent period from any acknowledged distressed customers, those bankruptcy filings in January would result in restatement, adjustment of the financial statements. Why? Because the asset was already determined to be impaired at year end. Remember, accounting treatment of subsequent events depends on whether they provide evidence of conditions that 1. Existed at the date of the financial statements, which would require adjustment, like this one, or 2. Did not exist at the date of the financial statements because it was sudden, it happened in January, which may require disclosure, footnote disclosure in the financial statements if the amount's material. So 15 is a big yes, and this would lead to a type 1 subsequent event. 16 now. Inquiring as to whether any credit losses have been reported in a subsequent period due to any sudden customer bankruptcies. Yes, a credit loss in the subsequent period due to a customer's sudden bankruptcy, that's going to result in a footnote disclosure only, no restatement of amounts in the period under audit this time. Why? Because the asset was not considered to be impaired prior to the sudden bankruptcy filing.